welcome back to Yuri's Box. In this video, I'm going to look at TLT 2008 comparison. If you enjoy this kind of content, consider leaving a like, and as usual, nothing in this video is financial advice. So before I get into basically the 30-year bond chart for just to keep things simple, as in my previous videos, we did get some more data out today, mainly durable goods orders. It came out better than expected, although the number that goes into GDP came out negative, which is non-defense goods orders. So the overarching idea is recession cancelled. Okay, that is what I read as soon as the numbers dropped. However, I reject really the premise of it, as I spoke about in my previous videos. What we really saw, in my opinion, with this first move down right here. Okay, let me just clean everything up. Isn't so much a pricing in of a recession. Okay, this move right here, in my opinion, was more about the fact that we came into the year with just pricing in all of the good stuff, none of the bad stuff. Also, it was pricing in a certain sequencing when it came down to policy. Okay, so we came into the year with the expectation that we would first have something like tax cuts or deregulation, something good for growth, and then throughout the administration we would end up dealing with something like tariffs, all the bad stuff bad for growth, really. The sequencing got flipped. We're not talking about tax cuts. We're not talking about deregulation. We're going into the third month. At the end of April, really, we'll be at the third month of the Trump presidency, and we still haven't talked about any potential stimulus to the economy. And that really leads me down to the first thing I want to say about the 30-year bond. Structurally, I'm not too worried about short-term fluctuations, is how I refer to the price action in the short term, really, for the simple reason that already going into the year, you already had some clues that something like the jobs market was cooling, and you get further indication of that in some of the surveys. Like if you saw my video yesterday on the all the reports that we've seen, at least on the survey level, okay, and now I'm the first person to doubt really more of the consumer side, okay, and I'll get into that later. But at least on the survey level, the so-called soft data, you are reading things that seem to indicate that we are in an environment that is more consistent with last summer rather than what we saw from September to January. Okay, so structurally and really directionally, really, I'm not too worried. Okay, my expectation is that this is a developing story, and it will take quite a bit of time to completely play out. Now, my expectation is that as we move towards the summer, yields will continue on their continue really to go to the downside, and bond prices to move back up. Now, let's take things step by step. Let's look back at something I pointed out in my previous videos. Now, again, I'm not arguing for canned tuna, sardines and a bunker, and should we hope that it plays out like 2008? No. Okay. And I'm really, I'm not saying it will play out. I'm just pointing out the fact that, you know, in my spare time, I looked back at history and I saw this fairly nice resemblance, really, between what happened from 2005 till really just before the outbreak of the 2008 recession. And so really, okay, so this is 2008 here. Okay, now what I highlighted was that before the 2008 uh, move down in yields here, what we had in the very, very beginning was the first uptrend, pullback, a bigger rally, albeit with a bit of noise in the middle, then sideways chop, leading to the first top, and then, this kind of W formation or shark pattern, whatever you want to call it. Then another drop, and then a retest of the bull market support band. Now, really, that's just as a point of reference. Okay, what we have today is, in my opinion, something that could be regarded as quite similar. You have the first move being a rally, pullback, kind of noisy, significant rally though, then sideways chop. And again, as I pointed out, this sideways chop is, if you remember, if you were in the space, that really coincides with really the bond market expecting extra cuts because of a possible recession. Eventually, that never happened, so bonds had to really play catch up, and so you had the first initial top, okay, which was at about 5.1, which in 2008 terms would really look like this initial top right here. What follows, as you can see in what happened in the 2006 and 2008 cycle, was a W formation. What we have exactly right here, W formation. Currently, we are, if you want to follow the 2008 price action, we are just after the first decline in rates, and we're at the bull market support band. Now, just so you can see everything better, we're kind of, the 30-year yield has kind of, poked its head up above the bull market support band, which again, you kind of see it happen right here. It could very well be that, say that next week we get tariff announcements, and that's one of the things I wanted to talk in this video really. Say that we get, significant tariffs, or somewhere between the midpoint and max point, something like that. That could cause a return to the flight to safety trade. Now, as I had highlighted in my, as you could probably see here, this is what I had written out in my previous video. So what am I expecting for April 2nd? What I really want to, what I'm hoping will receive an answer really is, are we treating tariffs as policy or as a tool? And I think that if you see pressure get put in the form of tariffs, you could argue that it is really that tariffs are being used as a tool. And what are we trying to get? What we're trying to get, what the Trump administration is trying to achieve, is a potential deal, namely between the EU and the US. I think that is the bulk of the problem, really. Yes, you have things like India having a lot of tariffs on the no, high tariffs rather than on the US. Other parts of the world have high tariffs across the board, as opposed to the US. But in my opinion, this is an effort that is aimed against mainly the EU. And the objective, at least on paper, in my opinion, is to get a free or rather fair trade agreement. So we break some eggs, but we get to have an omelet at the end of the day, is what I'm trying to say. If we don't get something that is aggressive, that is not trying to provoke some kind of a reaction, something benign, I fear that could be an indication that we're just treating it as policy, and that indeed it's not really trying to achieve anything. It's just tariffs to have tariffs, tariffs for the sake of tariffs. In any case, you still have to deal with tariffs no matter the outcome, okay? No matter, whatever outcome we get. We could still get other things like, just Trump goes to bed on the night of April 1st. He wakes up and he says, I had a dream. I no longer want tariffs. We'll just, sing Kumbaya by the campfire and we'll go on and buy our merry lives. That's a possibility. You also have the possibility of further delays. You could see tariffs get delayed altogether, or you could also see part of the tariffs get delayed of an extra month. That at least seemed something possible given what Trump announced in his interviews last week. Although last night I woke up actually in the middle of the night and I saw Trump threatening tariffs on copper and kind of walking back the flexibility rhetoric. So again, nobody knows what's going to happen on April 2nd. The best thing you can do is really speculate. And again, I don't know what's going to happen. What I'm really interested in watching for April 2nd is trying to get an answer. Are we putting in tariffs in place for the sake of tariffs, or are we using it as a tool? I'm of the idea that they're being used as a tool and they're really a baseball bat that is being swung on the head of the EU, and that eventually that will lead to a fair trade agreement in the near future so that the EU and the US can really act in a really in a united manner against potential other problems such as Russia, maybe more likely China. So I think the first step for TLT is really April 2nd. Okay, what is going to happen on April 2nd will determine whether we have a return to the flight to safety trade or we see more downside. Now, ever since we broke out of this downward slope trend line, what's been bugging me is the fact that at a historical level, just looking at like last year, we had similar price action where you had this trend line. We broke out of the trend line with a significant, strong price action, only to retest it later on, really a month later. Now, does this have to happen? Nothing has to happen. Although, when, given the context of history, and given the fact, which leads me to, the second argument of this video, given the fact that the negativity that we have, yes, it stems from policy, because you do have, as I've argued many times in my videos, you have tariffs and you have fiscal tightening, okay, acting as headwinds to growth. While you do have those factors acting as headwinds to growth, on the other hand, at the data, the level of the data, the hard data, meaning, things like, for example, today, okay, durable goods. I mean, it wasn't terrible. Was it great? No, because part of what goes into GDP was negative, but overall, it's not recessionary, okay? What is recessionary for the time being potentially recessionary is the surveys, really. That is all you really have so far to kind of use as a warning for a potential recession. And I've highlighted that in many of my videos. You see that in the PMIs. Now, granted, the last PMI come out for March was better than expected, but again, if you read the report in its entirety, we kind of get more of the same of what we saw in February. A return to what is more similar to something that is more similar to last summer rather than what we saw from September to January. And while it is true that we've seen that on the survey side, we still have not seen that translate into the hard data. So, to give you an example, non-farm payrolls. Okay? The last two prints have been benign. Now, have they been great? No. Have they been terrible? No. At least on the headline number, okay? Because then if you go and actually look underneath the numbers, you can make a lot of assumptions, if you just scratch underneath the surface. But again, just looking at the headline at the very, just at a very superficial level, things are still hanging in there. You have benign non-farm payrolls. We've had benign inflation reads. Okay. We get PCE out on Friday, which again I'm braced for the possibility of this being 0.4, as I've said in previous videos as well. Given the fact that when we got PPI, some of the components that feed into PCE came in a little bit hotter than the street was probably would have liked. And again, but I mean, overall, you can't really say that this is recessionary. And I go back to what I was saying before about the S&P 500. This move isn't so much about pricing in a recession. It's about reevaluating, the outlook. And those are two very different things, because I mean, it's one thing to say, "Oh, I'm pricing in a recession," and it's another thing to say, "Okay, I thought we were gonna have, rainbows, lollipops, and unicorns, and now I have to reevaluate. Well, we're gonna have rainbows and lollipops, maybe not the unicorn, maybe not the unicorns." I mean, it is just the beginning of a reconsideration of what the growth outlook looks like. And that is different than saying, "Oh, I'm pricing in a recession." If you're pricing in a recession, that you really have to go back in history to look for something like that. Really, what we saw in 2022, potentially when we got, and at the end of October, that's already kind of looking like some, pricing in a recession. Now, of course, we didn't have it, and that's why stocks just had to play catch up at that point. And again, the data just doesn't tell you we're in a recession. Now, again, the so-called soft data, so all the survey side that I've looked at and made videos about on the previous days, that is where the pain is, and it still has to translate into into the hard data, which is one of the reasons why I'm expecting a rally back up to the bull market support band. Now, it actually could not even maybe not make it up there, but again, I wouldn't bet the family farm on that. And it's also what is leading me to believe that there is, at the very least, a chance of a retest of the this trend line right here. So that would actually be at this point around the $86 mark. Does it have to happen? Absolutely not. But given the fact that we still don't see really the so-called smoking gun, as long as we're in this environment and this is the data, it's simply a possibility. Okay. Now, while we're on the topic of making comparisons with the past, one of the big differences and one of the reasons why potentially people have a problem with sequencing. Why is sequencing a problem when it comes down to tariffs and some say something like deregulation and tax cuts? Because actually, last time we got tariffs in 2018 and 2019, what we got first were the tax cuts and all the growth positives. And those, you could easily make the argument that those factors contributed to really creating the buffers for the economy, kind of the shock absorber. In Trump 2.0, we have the possibility of really compounding negative um, uh, really negative headwinds again really headwinds to growth, because again we're coming at a time, tariffs really come at a time where things like the quits rate is at cycle lows. Now on April 1st, if I'm not mistaken, we'll get another read, but overall we're still at cycle lows, which indicates that people are telling you that they don't see abundance in the economy, and so that they don't have the tools to drive wages higher, which again, I've used this to argue ever since I started making videos that inflation isn't really the number one priority. It would be if really labor market participants had the tools to chase higher wages. That is not what we're seeing. Tariffs come also at a time where you're really seeing some, really at this point it's still very, very, very benign of a level of fiscal tightening. Okay, so you've seen a freezing of the hiring at the federal level. You also see some anecdotal data of state and local spending from the pandemic stimulus era really drying up. You see some of the Doge efforts to really cut spending, contracts, and the way I've argued that would what effects that would have is really the way you have to think about it isn't so insofar as connected to something like initial jobless claims, because that is the direct effect. Okay, well, the way you have to think about it, in my opinion, is that for every person that's working, just draw a parallel to your own world. You're a worker, you have your job, and you have a circle of people around you that you interface with. Same thing applies to federal workers and federal employees. If they're losing their job, there is someone else that is getting affected by the fact that they lost their job. So imagine restaurants, other offices, contractors, so on and so forth, that potentially get affected. It is also true that the fact that you're seeing this kind of, let's not even say tightening of the belt, because we really haven't seen anything aggressive, okay, apart from the smoke and mirrors and nice words. That's just saying that we're not loosening the belt, okay? And the fact that we no longer have direct stimulus in the form of extra billions being distributed to the economy, that is negative to growth. And again, coming back to the differences between Trump 1.0 and 2.0, we are talking about negative actors when it comes to growth. Again, tariffs and fiscal tightening. They will continue to act as headwinds to growth. And in the meantime, we're still not even discussing of new stimulus. we still don't have new tax cuts. What is being discussed is the renewal of the tax cuts that we have in place since 2017 or 2018, really the TCJA, if I'm not mistaken. Which again, the renewal of those tax cuts wouldn't really act as a stimulus. I mean, as stimulant. I mean, it would just confirm the status quo. If anything, if they don't get confirmed and renewed, it would act as, again, another headwind to growth, because it would actually correspond to potentially a tax hike. Okay, so directionally, when I look at TLT, when I look at, just to keep things simple, the 30-year yield, could we see, further follow through a bit higher, potentially even to the 480? Perhaps. I'm definitely not ruling that out. However, looking towards the summer, given the fact that we're still talking about tariffs, we're still talking about, at least on paper, reducing the deficit. Now, call me skeptic, but at least as things stand now, we still haven't seen anything really too dramatic. But in any case, that is the intent. And so at the very least, we're not seeing any increase for the moment, for the time being. And as long as those factors continue to linger in the environment, well, directionally rates, as far as I'm concerned, will go down. Now, what would cause me to significantly, have to reconsider this is if we saw something crazy. Is if we saw really some kind of stimulant, and stimulus package being introduced at, in a short time's notice. Say something like the Fed cuts rates by 200 basis points and restarts QE. Even though they said they wouldn't, because they're only going to do QE if rates are at zero. But let's say something like that happens. I'd still be in the camp that rate cuts, just like rate hikes, take time to have an effect. You have to give them time. Again, they have rate hikes act with a lag, rate cuts act as a lag. That is, unless you have, you basically go back to the zero bound. That would be even more than 200 basis points of rate cuts. That would be 450 basis points of rate cuts and QE. If we saw something like that, then of course I'd reconsider. If we saw, again, what I was talking about about the stock market and what will happen on April 2nd, if we see tariffs get walked back, that is definitely a move in the right direction. Okay, no tariffs, status quo, and you get rid of tariffs. Okay, so you no longer have to worry about tariffs. That would be a move in the right direction, and being a move in the right direction would be a move in the wrong direction for bonds. So really, going back to the original point of the video, is the 2008 comparison still in play? I would argue yes, it is. And if you had to draw a parallel, as I did in my previous video, you could say that this candle right here, when the 30-year yield poked its head up over the bull market support band, corresponds to this move that we're having right here now. Okay, and overall, the idea is that this is a stretched out version of 2007. And again, what could cause this to kind of deviate from it on yields going higher, as is what I was saying just now, if you see some kind of stimulus package get introduced. If you see some significant stimulus get introduced, you really be prepared for rates to move significantly higher, especially on the long end. But as long as you continue to have tariffs and fiscal tightening, expect more of the same, and it'll only be a matter of time before what you see at the survey level, kind of spill over into what we saw, really into the hard data. Now, again, if I had to choose between which surveys to pay attention to, my favorite is the PMI. It to me it just seems the least probable to get what I'm trying to say. You get less noise with the PMI report rather than something like the University of Michigan. Something that I looked at yesterday as well was the conference board. Of course, I'm going to look at them and do a better job of talking about something like the University of Michigan survey when we get the final print. But in any case, when you're asking consumers their opinion, their consumers' opinions can really be skewed by political affiliation, and that's where my distrust for these kind of surveys, where it stems from. The PMIs are about business, and what really managers are telling you. And if managers are, they don't really care about who is in office, as long as the policies are positive for growth. If they see something that is positive for growth, yeah, the more the merrier. So in that case, you actually have a reason why why potentially you could easily say that the PMI report isn't skewed by political affiliation, but I could be wrong. But in any case, that is my personal preference. So again, as long as you see tariffs being a factor and fiscal tightening being a factor, directionally rates should continue to move down as the growth narrative continues to sour. Growth outlook continues to sour somewhat, and I really think we'll have to assess around June to September. That is kind of the time frame we have to look at. Okay, what kind of shape is the U.S. economy at that point? What are we looking at? Do we have to consider seriously some kind of a landing, or was it just a great buying opportunity in stocks? I think this is a developing story. As I said, I'm not expecting anything in the short term. Granted, next week we do have non-farm payroll report. Tomorrow we have another initial jobless claims print. I look at the initial jobless claims as an indication of where the next unemployment rate print will come at. And again, next week's non-farm payroll report could easily, be a shocker and come in extremely negative. Could be, what we saw in all the reports I looked at yesterday, definitely kind of seemed to, point in that direction. Let me see if I can find the employment. Decrease in production. Again, yeah, this is the Philly Fed manufacturing where employment kind of rose a bit. This is the PMIs. Let me see if I can find anything else. On balance, the non-manufacturing. Again, manufacturing says it kind of increased a bit. Non-manufacturing said it decreased a bit. I'm not expecting anything too definitive next week. Just remember, as the saying goes, it's the most important non-farm payroll print until the next one, and for good reason. So again, wait and look for the data. Don't stress short-term data. Short-term price action. Really, it's kind of a freeing sensation in my opinion, because whatever happens in the short term is kind of irrelevant. As long as you have structural confirmations of the slowdown, you really don't have. You have all the reasons just to go outside and touch grass is what I'm saying. Definitely don't stress too much. And again, I'll be here and I'll do my best to keep you updated on what TLT is doing. We'll assess assess the situation as the data comes out. So to wrap it up, really, we still have a situation where potentially the 2008 comparison is still kind of holding ground. Really, if you had to draw a parallel, where in this moment right here, where the 30-year yield, kind of popped up above the bull market support band, and what was really a quite a strong sell-off. 11 basis points, um, quite similar to what we're seeing now. Again, the overall idea, as I said it before in the video, it's just this is a stretched out version of what we saw, potentially at least, on 2008. Obviously, I'm not advocating for can tune, as I said in previous videos as well. So 2008 comparison is potentially still playing out, although I wouldn't, bet the family farm on that. And really, you're not going to see any further progress on rates until you get some indication in the hard data, such as unemployment rate going higher, non-farm payrolls, plummeting, and and again the meat of the data just turning south. But again, by the time the hard data kind of turns, you're already knees deep in the in bad news. So again, we'll see how things come out and how they play out. So I'll leave it at that. If you like this kind of video, this kind of content, really consider leaving a like, and I'll see you next time. Bye.